Welcome out to Tackle Train's Halftime Report. We're here on YouTube for February 27th. We got a lot to cover, including updating everybody on exactly what is happening with the coronavirus out there and the expansion. Obviously, that is now completely in the social conscious, and we're going to be here every day to kind of update you on what is the news, what's happening in the market, what's happening from an economic perspective. And we're here to just give you the news, give you the analysis, and on that as well. I want to welcome out Coach Noah. Coach Noah, how you doing today?
I'm fantastic, Matt. It's tough sledding out there, but I'm excited to be here.
You know, it really is tough sledding out there, given the fact that, we've seen now 6 days, 6 consecutive days to the downside, increasing volatility, increasing volume in the marketplace. Obviously, as these things get into the social conscious and you start seeing them on CNN and Twitter and Facebook and Fox News and, Bloomberg and Reuters, and everybody's reporting about the coronavirus, people wake up and they go and they look at their 401ks, they go look at their stock holdings, they go and look at their investments, and they just get a little concerned. And that's what we've been seeing is this concern, as it is spreading, is now having an impact on the marketplace. And we'll get into all of the news from the stock market perspective, currencies, commodities here in a second. But I want to bring in Coach Mark here. Coach Mark, how are you doing today?
I'm doing terrible. So, not financially, just
Mark's in his bunker. Mark,
listen, I've been in my bunker for 5 weeks, so y'all can catch up to my bunker, and there's no room. Sorry.
Listen, like I told Mark earlier today, it's better to be paranoid than regret, right? It's better to be paranoid than regret those actions. So I definitely understand that. You and I share that type of paranoia as parents. There's no doubt about that.
Mark, so wait, you're saying that preppers are smart and everyone should be prepping for the apocalypse?
Listen, I'm just saying. Listen. That's all I'm saying.
Oh, I have food storage and I have a bug out bag myself. I'm just saying,
Okay, then. Go get your tinfoil hat on there, Cody.
That's not crazy at all.
No, I got my bug out bag. What are you doing? Is the CIA tracking you? Come on.
No, it's just like, if you got to leave really quickly, there's an earthquake, there's something happening and you got to get out. It's got,
what's in your bug out bag? Before I can bring Mark on to give us an update, I need to know what's in your bug out bag.
It's got 2 weeks worth of food for 2 people.
Okay.
Or 4 weeks for one.
You need to update that bag. You've got a baby on the way.
You better get a third in there pretty soon.
And you better be adding diapers and things into that bug out bag.
I probably will need to be adding things like that. And then it's got, everything from just matches, knife, some rope, things that if you have to survive outside.
You have to survive in the wilderness of Hawaii.
If you have to survive in the downtown metropolis.
There are people who get lost in the woods out here and die every year.
Cody's bug out bag in about a couple months from now is going to be a diaper bag. Mark, how you doing, buddy?
Mark, not good. Because
Chucky, can you just kind of give us the breakdown on just high level the news that we've seen over the course of the last 24 hours since we were here with the team?
All right, so let's break down the coronavirus from a schematic standpoint. One, we now know that it spreads fast. News reports out of South Korea, there are more confirmed cases yesterday than China had confirmed cases yesterday for the first time. So we now know we have 2 clear cases, China in the early days, where you saw these huge growth numbers in total cases. And now South Korea, where you're seeing big, huge escalations on a day-to-day, very similar to China. So we know that this virus spreads quickly. So we know that. Cases. 2, we are starting to see a number of quarantines, the wrong word, but precautionary steps. Japan has closed schools. Saudi Arabia has, what was the specific?
They're not allowing pilgrims into Mecca.
They have banned Mecca pilgrimages,
which is a big deal. That's not a small deal.
Israel has.
That's like the Vatican shutting down pilgrimage. That's a big deal.
No,
Israel. I think it's even bigger than that because by their religion, they're supposed to try to make at least one pilgrimage in their lifetime.
Yeah.
So that's a huge deal.
There's talks of the Tokyo Games potentially being canceled this year. Israel has banned people from Italy that are non-Israeli from coming into the country. We're starting to see and once again, I don't know what the right word is for it. It's not a quarantine, but these limiting things where functions of travel are being shut down. Quarantine type effects with schools being closed in Japan. Japan's cases are starting to climb at a high level, and this is very scary. They're starting to climb in the early stages, jumping up in these little mini doses like we saw in South Korea. So we're seeing evidence of how this now spreads very quickly. We're seeing evidence of how human behavior reacts to it, shut down, isolate, which obviously is going to have a big impact on GDP numbers, on commerce, on spending. And we're starting to see countries get their first case ever. Greece, Brazil, Pakistan, Georgia, Algeria, Norway, Romania all confirmed their first cases. And so we have this little domino effect going on. Virus hits someplace, spreads quickly. Countries do what they think as prudent precautionary measures to try to isolate and stop the growth of this virus, which we still know so little about. Cody, you were sharing with me that the first time someone contracted it for the second time.
Yeah, there was a woman in Japan who got the virus for a second time.
So, yeah, I mean, that's where we're at. I mean, we are at the same. You know what's funny? For 5 weeks, we're no different today than we were 5 weeks ago. We have an unknown situation that we don't know the outcome. The headlines are just worse today than they were 5 weeks ago, and we're seeing those. And I hate to break it down to economic terms, but we're seeing the impact of what this has on society.
Well, don't we have to break it down from an economic perspective, though? I mean, that's kind of what our job is to do. And Mark, when you're talking about Microsoft today being the latest to warn on growth forecast, Goldman Sachs today warned of a zero growth environment for 2020. And I just want to remind people yet again that the entire reason the market was up 30% last year had nothing to do with politics, but had everything to do with the market belief system that growth was going to come back in 2020. Budweiser announces today that it lost $170 million in the first 2 months, specifically due to the coronavirus. Bookings.com warns of rooms basically being decreased in by 5 to 10%. And so, yeah, and not only that, Mark, but all you need to know is this. The IMF and the World Bank are discussing canceling meeting in person and instead just doing conference calls. And I say that happily, jokingly, but when the world elite is like, we're not going to meet with each other because the health minister of Iran just died, we're going to have a conference call. But with all joking aside, Mark, a lot of these spikes in cases we've seen in Korea was not when you had somebody travel from China to Korea, from Japan to Korea, but once you have a community spread. And in the US, and this is not fear mongering in any capacity, guys, we just need to have the understanding the data. We just had our first case of community spread in California. So this is something, and I was a little upset with what the president did in his press conference yesterday, but this is something that I think is now just, like I said last week and the week before, this is the beginning of something, not the end of something. And now that we've had our first case of community spread, it's going to get even into more social conscious within the US. And so hopefully we can, hopefully this is just something that is short term. And, we kind of look back 5 years from now and it's kind of like SARS and Ebola and H1N1 and, MERS and everything like that. But we have to look at it, objectively in this type of situation. And this can absolutely have a global economic impact. When Bank of America slashed their growth rates for the world GDP today. And guys, when these banks and these institutions like the IMF, the World Bank, the central bank, and so on and so forth, when they start slashing forecasts, a lot of times they don't slash once. It's kind of like interest rates. They slash a couple more times. And there's word that we're now starting to see a 90% increase, 90% probability of a decrease in interest rates in June. that increase is half, like there's a 40% increase for a decrease in March. But Christine
And Matt, before
Lagarde,
that, there's talks of people calling for them to do an early decrease even before their meeting.
well, that's not going to happen.
I sure hope not, because that's a
It's not going
out
to
of
happen.
that's a crazy.
That's Janet Yellen putting something out to the Bookings Institute.
She couldn't get interest rates low enough.
Janet Yellen is the same person who said we're never going to see a recession or a bear market again in their lifetime. The hubris of the central banks who think they can stop all world problems with monetary policy is amazing. Janet Yellen called for the world central banks to come together and attack this problem from a financial perspective. Christine Lagarde, the head of the ECB yesterday or this morning, said we're not there yet. So I just don't think the central bank is going to act before. Now, whether they start decreasing interest rates coming into March, June, September, and December this year, I certainly expect them to start decreasing interest rates in that capacity. So, Mark, I get it that when we're dealing with a massive human condition situation, some people don't want to talk about economics, but it's the economics that has a bigger impact on most people's lives.
The two other things I'd like to know and put them out there. We pull up Budweiser's chart, BUD again. An extra risk that, and this started about a year, 15 months ago, where companies would come out and to the day and announce, forward guidance shocks, like, hey, our earnings aren't going to be as good. Remember when Apple did that and dramatic down? You have an extra catalyst in the upcoming days and weeks that you haven't had in a long time, where a company will come out and preemptively get ahead and say, hey, coronavirus is going to hit us hard, our bottom line, where out of nowhere, there's already risk to the coronavirus weighing on the market, but out of nowhere, an individual company can come out on any given day at this point and say, we're going to get hit hard. And, Budweiser down bigger than the market right now.
And Budweiser's on its actual earnings report, but you're absolutely right, Mark. We saw it with, Hewlett Packard. We saw it with Apple. We saw it with Microsoft. We've seen it across the board with a lot of companies warning about how the coronavirus can impact their bottom line. And, and I certainly believe it's going to do that. I agree with Goldman Sachs that we're in front of a zero growth environment this year. I truly believe we're in front of a zero growth environment. And on the backs of the last 3 years where the market is up 50% and it's just absolutely skyrocketing on the hopes of growth in the future, that's got to be extremely concerning. And Noah, I want to get your take on something. Let's come back to the S&P 500 real quick. Noah, we hit correction territory today. And for those of you that don't understand what a correction is, a correction is a 10% decrease in price from the very top of the marketplace. A bear market is a 20% decrease in price from the top of the market. And so a correction is anywhere between 10 and 20%. A bear market can be anywhere between, 20% and, Great Depression, 90%. So that's where we're at right now in a correction. Now, most corrections, Noah, are typically bought up by the marketplace. Most corrections are. Would you agree with that?
Yeah, I would say 9 times out of 10, maybe more, you'll see people buying the dips.
Okay. With that said, this is also perhaps the fastest correction we've ever seen in stock market history. And we are on the back half of a week that is currently, we don't know how it's going to end. I mean, the market's obviously recovering off that technical, and I'm going to have you break down the technicals here in just 1 second. But this is also on pace for the worst week we've had since the Great Recession in September of 2008. Noah, give me your technical breakdown, because like I said a couple of days ago, the market's in a very important spot. It's setting on major support. I was talking about the Dow. I kind of feel the same thing about the S&P 500 right now, which is a better barometer of overall market performance. Give me your technical read on the S&P 500.
Well, yeah, I mean, this is a big number. It came down pretty close to the 3,000 mark. We're hitting that 200 period moving average. We got all that old support resistance in there. And at this moment, you're seeing a hammer style candle, longer shadow. It's not a green hammer, but it's got a long shadow. So what you're seeing is an intraday recovery on that. And, you put this in a context with multiple time frame analysis. that's a big down week. And if you look back at previous market corrections, what's taken 2 weeks, what's taken 4 weeks, what's taken 3 weeks, 4 weeks, this is covering that distance in just a week. So pretty stark down, but that's a big support resistance zone. And 3,000 is a big number psychologically, big threshold, price point. And again, we'll take that down intraday, down here on a 1 hour chart. Let me go to a 15-minute chart. You can just see a little V-shaped recovery here shortly after the open. Boom, about 8:30 Mountain Time. That'd be 10:30 Eastern. You're seeing it recover back up. Now, in order for me to get more confident about this being anything other than a short squeeze type thing, it's got to start taking out resistance. It's got to get back out above 3,100. And then by the time it does that, Matt, I think if we do end up getting a rally here, I think it's got to get out above 3,100 for me to have any confidence in a short-term rally. And I only think it'll last for a day or two if it does. Because I think that there's still fear out there and there's a lot more. The second shoe will drop at some point in time, I think.
Matt,
yeah, go ahead.
Let me share something from a technical. I've done an in-depth moving average study, as I've referenced many times over the years. I did that study before I came to tackle trading. I did it. I've updated it ever since. And whenever you have a first test, and longtime lounge listeners, old school, will remember me referencing this many times. Whenever you have a first test of a major moving average, which is occurring today on the 200-day and on the 50 weekly, there is a really, 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 really high percentage chance that those moving averages hold. Now, the why of it is more theoretical, but it primarily has to do with algo buying, computers and how the exchanges. It's a whole complicated theory. But the raw numbers are overwhelming, like 90+% overwhelming.
80-90% of the time.
Like ridiculously overwhelming. So from if I didn't even know what was going on today, I would look, I'm like, oh, we have a first test of the 200 in forever. We have a first test of the 50 weekly forever. And so it's very, very normal forget what's going on in the real world. When you test these major moving averages after an extended period of time, statistically speaking, they have a tendency to hold for that time period. It gives zero indication of what might happen afterwards. Like sometimes they'll hold and they'll bounce. Sometimes they'll break afterwards. But on that day itself, so it is not surprising to me at all, based on that extensive study, that you see a bounce off these moving averages. It does not mean that the market is not fearful anymore.
No, and it doesn't mean that the market's going to V-shaped recover to the same degree that we saw in January, February of 2019, right? After coming out of that tremendous downward movement in price in December of 18. So, but aren't investors trained to a certain extent to buy on corrections?
I don't care what investors
are. Well, I know, but I'm just saying.
But what are algos trained to do?
Well, algos are trained to buy and sell based on technical analysis, based on moving averages, and so on and so forth.
Yeah, and look, and remember on Monday, Matt, when we were doing the halftime report, and I talked about moving average gaps.
Yeah.
And how big that gap was between the 50 and the 200. Yeah, here we are Thursday, and it filled that gap between the 50 and the 200 like that. Technical analysis. I had a question today, Matt. I want to get you guys' take because this question came from a student who said, I can't attend the halftime report because I work during this and I have to watch the replay, which we have a lot of people that are watching this afternoon, tonight. And he was talking about kiss of death. And I don't want to get into the specifics of the question, but I want to take this. He was talking about kiss of death signals. And, in this current market condition, would those type of signals be easier to read in a bear market? And my take on it, I want to hear you guys' take on it, is that technical analysis during these really volatile times, those classic measures, those classic things, they're really hard to use in an ongoing news environment where the news is just changing daily, where you don't know where tomorrow's headlines will take us.
Well, okay, I know where you're going on that, Mark, and kiss of death patterns happen after the first break, after a reversal pattern. And it's a retest of old support, new resistance. And you have short-term kiss of death patterns. You have long-term kiss of death patterns. And in the short term, when you're looking at on a daily chart, it's so hard. I mean, it's so hard because you have so much whipsaw. You have so much volatility. You have so much. You have things in the headlines. Kiss of death on the weekly chart a little easier to understand, but the problem with that in this environment is when you had the kiss of death in 2008. No, if you give me a long-term weekly chart in 2007, 2008, when you had the kiss of death in March, April of 2008 on the weekly chart, you didn't have and you'll see that kind of happen, that M formation in June, July, August. The violation of support happened in December of 2008. The kiss of death occurred in April of 2008. And when you have that kiss of death in 2008, in April of 2008, Mark, the biggest difference is even though traders were aware of the subprime market, even though Wall Street was aware of the risk and the over leveraged nature of the subprime market, and and even if we had seen some of the problems with Bear Stearns in March of that year, it wasn't in the social conscience. It wasn't in the people that were in 401ks were not concerned about their 401k because the market was down 7%. It was down 7% over a 10-month time period. There wasn't a lot of news that was happening. It wasn't until Lehman Brothers in September of 08, if you'll go to September of 08 there, Noah, it wasn't until Lehman Brothers that when that news then came into the social conscious. And when that news came into the social conscious, it's happening today as well. When all of the news media is reporting on the exact same thing, all of a sudden people wake up and they're like, oh my God, I'm looking at my 401k and I'm already down 40%. And then they capitulate and you see that massive spike of volatility to the downside. And then the Fed comes in to save the day in October, November, December of 08, announced quantitative easing in 09. And you could say the exact same thing about the market cycle in the dot-com market cycle when, in March of 2000, you double topped in March of 2000. You violated support level in 2000. The market was already coming down in 2001 when that next black swan event, and that's kind of what we're talking about here is those black swan events. That next black swan event happened in 2001 and with the terrorist attack of 9/11. And then all of a sudden, again, it comes into the social conscious. People wake up to the economic reality of the situation. They look at their 401k, their retirements, their long-term holdings, they're down 40%. And they finally capitulate in the face of the Fed coming in and stimulating the market again. The fundamental difference in those two situations between dot-com subprime and whatever you want to nickname this one, the Bernanke bubble, the all everything bubble, this is just batshit crazy bubble, whatever, however you want to categorize it, this is happening at the top of the market where we were at all-time highs just a week and a half ago. Whereas in those two situations, you were already down 40%. And the kiss of death occurred where there was no social conscious type problem here. So I do believe that because we're at the top of the market at elevated price happenings when this potential black swan event happening with the coronavirus, I think those daily charts are going to be really, really difficult this time.
Well, and Matt, I mean, both of those events were really pre-social media. 2008 was in its infancy, and now the market, social consciousness moves at the speed of Twitter and Facebook and everything else. Like people are plugged in.
Well, and not only does it move at the speed of Twitter and Facebook and Instagram and so on and so forth, TikTok, whatever social media channel you use, but the spread of misinformation is much higher today than it was. I mean, you and I were talking in the pre-production show about sometimes when you're looking at Twitter and you're getting your news off Twitter, you kind of got to take a step back and be like, okay, that's somebody's take on the news, but is that actually what is really transpiring out there in the marketplace? And so we live in an environment of, interpretation of the news, and people always because a lot of people don't trust the news medias because it's all paid per click type, clickbait nonsense. And so you really get these secondary takes from the news. And a lot of that could be the spread of misinformation as well. So the fear can grapple the market faster today And not only that, but we didn't have the algorithms back in 2000 and 2008 the same way we do today. And so it doesn't surprise me we had the quickest correction in stock market history.
It's a beautiful day outside, by the way, if you haven't been outside yet.
It is a gorgeous day outside. So does that answer that question, Mark?
Yeah, and you know what I find interesting though, when you go back, when you were looking at the charts, you know what happened the first time it came down to the 200 weekly in 2001 and 2008? It bounced.
It bounced.
Like,
well, that's what has to happen to create a kiss of death formation. Remember, a kiss of death is the first retracement off of a reversal pattern. And when it comes down into those levels, it kisses off those levels, it retraces back into an old support level, i.e. new resistance. I mean, the reversal pattern in 2007, 2008 was just textbook. It really was. This one's going to be faster, in my opinion. And this could, we jokingly say this, but this could be the fastest bear market in human history, where, economically it might have a longer lasting type economic impact, but the market can recover. The market can go down into bear territory and V-shaped recover the same way it did in 2019, in January and February of 2019, 2020. So if people are, and I think most people are having a difficult time with this market.
And I want to highlight something you said to go back to the student's question, like where you said daily charts are going to be a lot more difficult from a technical perspective in this market condition than perhaps weekly charts. Like, over time, like longer time frames are going to play out patterns a lot easier. You have so many algorithms, and you have so many day traders, and you have so much short-term price movement that can impact any given day. You see huge drops, you see huge rallies, like the price action of a given day on these like huge mega news stories is not naturally indicative. If like a lot of you were not around in 2008 when this was going down, but if you looked at the daily charts before things just went free falling, in the height, I mean, is there any way you can go back to 2008, Noah, like on a daily chart? Like
what time of daily? Yeah.
In the summer of 2008, when this stuff was breaking news, it's a little history lesson, but I think this is one of those really appropriate times where history is really, really important. You saw massive days. I refer to the trade war and the back and forth days, but you saw massive days, even at the beginning of it, where things would rally. Like if you highlight September, October of 2008. So even in the free fall of it, you saw days where the market was up huge on various news.
Mark, that candle Noah is pointing at in October was a 10% upward movement in price.
And those were directly correlated to Fed action rate cuts. It was rate cut. This was like, half point rate cut, 3/4 point rate cut, ZERP. It was like, boom.
Yeah. And so like, even in the midst of chaos, you're going to see days in these heightened fear environments where day traders, algos, market euphoria, market relief, whatever you want to call it, creates these massive, huge days, which creates this false illusion on that day that, hey, the worst of it is over. Look, how could the market be fearful if the market's going up 10% today? Yeah. And so daily candles can be really, really difficult in chaotic environments to get a read of what true market sentiment is.
And I'll tell you, even if this market turns green today, Mark, and let's come back to right now, Noah, but even if this market turns green today, that's not an indication of put your chips in the middle. Jim Cramer said like literally 2 days ago, let's push our chips in the middle a little bit, and the market was going down. I'm like, no, let's let it.
Cramer really said that?
Yeah, he did. Now he did say just a touch, but he did say that. But it was not as bad as Trump saying this is a buy opportunity a week ago.
Why? I mean, I just don't get, I don't get why people haven't had the general note of caution. Like during this whole thing, we haven't been, the world is ending.
No, just be cautious.
There's disaster and the apocalypse is around the corner. But prudence and caution has been for me, a no-brainer the last 5 weeks.
You have to let the volatility slow down as a buyer. As a day trader on the short side, you're trusting your signals from a technical perspective. But if you're looking to buy Apple, if you're looking to buy Microsoft, if you're looking to buy Google, if you're looking to buy Applied Materials, if you're looking to buy any stock, I'm not talking from a short-term trading perspective. I'm talking from an investing perspective. You got to see volatility subside. And you know what? When I'm looking at volatility, I'm looking at the lengths of the candles and the speed of the movement and the increasing volume. But I hesitate to do this, but no, give me the VIX.
Yes.
I hate
She's
it.
a broken, the VIX. She's a
I
broken.
hate it.
Yeah.
stand it.
This is the
It
time when the
drives me
VIX is actually worth something.
just drives me nuts. You got to see the volatility subside, and volatility is still increasing. Look at the lengths of the wicks on the candles. Look at the bodies. I know halftime crew. I know team tackle. You guys can make fun all you want. I deserve it on this, but you got to see the volatility subside. You got to see that come back down. You got to see it come underneath those 20 handles. You got to see the movement slow down a little bit. And as long as we have a VIX that's above 30, you got to be cautious as a net buyer right now.
What is the incessant need of human beings like Kramer and other investors that have to I have to take action today?
Because they're permables. That's who they are. They make fun of.
And I'm a permabull. I'm a permabull. But I'm like,
yeah, but you're not a permabull because you have caution and you're not going to just buy everything, buy, right? You're not a permabull. You're a trader, right?
I'm a bullish bias investor.
I will always have a slight bullish bias. Yes, because markets over time go up, not down. Over time.
It just seems to me to be so irresponsible to say. I mean, why can't you do it 2 weeks? Because you might get it just seems ridiculously.
Patience is a virtue, isn't it? And cash is a position.
It's also a position, right? And you know what? In these types of environments, I'm okay if we get another like from today, right now today, and we just get that V-shaped recovery that we had in January of 2019. And guys, I missed out on that recovery of January of 19 because I was like, I didn't trust the signals. And if we get another V-shaped recovery like we did in 19 in the next month and a half, I'm okay missing out on that as well because the number one quality of a trader and an investor is not about going out there and pushing your chips into the middle and hoping markets go up and begging markets go up and becoming the chart whisperer because you want it to go up so much. The number one quality of a true investor is risk assessment.
Hey, Matt, I just have literally a headline coming across the wire right now. Steve Mnuchin and Larry Kudlow were just added to the coronavirus task force.
Oh my!
I literally found myself fantasizing if we had like a bat signal for like the PPT, like you could flash up in the sky type of thing.
No, you're a creative man. You need to create that logo.
Does every human being?
Let me get this straight, Mark. Let me get this straight. So the economic advisor, Kudlow, who has been basically saying nothing to see here, that it's not going to impact the United States, that it's not going to have any impact economically on the United States. This literally been pushing this propaganda bullshit for the last 2 weeks. He's now on the Corona Task Force.
Yeah, and Steve Mnuchin.
Hold on. The Treasury Secretary, PPT, Steve Mnuchin, who literally has no business. Is he a healthcare professional? Is Larry Kudlow a healthcare professional? Put healthcare professionals, put CDC.
Larry Kudlow and
health
Steve
organizations
are now part of the coronavirus task force. Now, I listen. That's all I needed today to just feel safe. I'm gonna I don't need to buy any more food storage. I don't need to be precautious.
Yeah, everything we've said today just makes no sense. Everybody, shut up and buy because Larry Kudlow and Steve Mnuchin are now on the task force to cure this problem.
Listen,
this world has lost their mind.
We have said all along that and once again, for anyone that's joining us for the first time who says you guys are a lot of doomsayers, blah, 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 we have said this entire time that there is very likely a very good buying opportunity at some point in the future. We are not going to be foolish enough to try to predict when that is. But,
to be fair, we've only had one person call us a doomsayer. We only had one. So,
Well, we've been called a lot of things, but I don't know if that's one of them. Did I
uh,
mention it's a beautiful day outside? It is really nice out there.
Yeah. Did someone literally call us a doomsdayer?
no, they just call this all wear our sell side hats.
Oh, I don't know.
All we call it sell side.
No, like Larry Kudlow and Steve Mnuchin being added to the task force as headline news. It's some of the stupidest things like you see, and like there is zero chance that they have anything of merit to add. There's zero chance that they have anything to calm or reassure the public. Steve Mnuchin should never be allowed in front of a camera because he has the opposite effect. Remember when the market plunged 2 Christmases ago?
Oh, yeah.
Like
that was
2 Christmases ago. If you weren't trading, then Steve Mnuchin got in front of he was like, he actually caused a market panic when he was speaking on a subject.
He did. The market was getting smoked. Mnuchin should not be able to talk in public, but
So
what are we doing here? I mean, this is a national healthcare, I don't want to say crisis yet, but the World Health Organization is literally a stone throw from calling it a pandemic. And so it really does frustrate me that from a political perspective, this is more about who's to blame politically. How are we going to make sure that the stock market doesn't sell? How do we make sure that the stock market, we're in an election cycle, we need the stock market to go up. So let's put Steve Mnuchin and Larry Kudlow, who has zero experience in this capacity.
and I love Larry Kudlow. Like he's an
not a
entertaining
fan.
guy.
I'm not a fan, but I get why you are.
He's an entertaining.
Listen, Mark, I don't even mind Mike Pence being Trump saying Mike Pence is the.
I don't have any problem with that.
He's got some experience in this from an Indiana perspective, right? So he does have some experience as governor of Indiana when I believe I don't know if it was the H1N1 that came out, or I can't remember which one it was, but he does have some experience in navigating these types of things from a governor perspective. I don't mind that in any capacity, but to put Steve Mnuchin and Larry Kudlow on that is so indicative that this is more about the political response to this than the actual healthcare response to this. And that to me is really disgusting. That to me, that's my opinion. Nobody has to share it. That's my opinion.
What is it going to take, man? You asked a question in pre-production meeting, and on days like this, where this is such a massive story. Normally you guys have a routine on the halftime report. This is bigger than your average day. This time period. It's going to be a lot of free throwing thought. But you asked something in the pre-production meeting where you said, I would like to discuss at some point what was it going to take for you to say that it's a buying opportunity, for you to have your Jim Cramer moment, which was apparently
just analyzing, like for you personally, what do you need to see for you to be like, it's time for me to, maybe not push the chips into the middle, right? I mean, we're hedging long-term investments, writing covered calls. And no, I heard you did an absolutely fantastic job in the Tackle 25 last night. Great job. And for the Tackle Trading Pro members, everybody give Coach Noah a shout out for the Tackle 25 from last night. But Noah and Mark, obviously those long-term investments, we're not going to capitulate on long-term investments, correct? They're long-term investments.
Yeah, you manage them,
but you're going to control the risk. Like you make call or something. You might take some action, roll your calls down, type of thing. Protect, but you don't bail out, because I do believe that what would take a nice little vaccine, and then boom, market stabilizes.
Honestly, it might just take the Fed saying we're doing quantitative easing. So
a vaccine, like I said. So
yeah.
Yeah.
I see what you did there. But no, on the downside, you're looking to add to long-term positions on the downside for dollar cost averaging reasons, for, you're looking to write covered calls against it to offset the risk. You buy back those options as the market is going down to reissue those options back into the market. If you get really worried, you go out there and buy a put option against it to hedge it, but you don't get rid of it, right? My question was, at what point do you start adding to it, right? As the market is coming down and you're looking to add to a Disney or to an Apple or to a Microsoft or to Applied Materials or to a Bank of America or whatever the case is. And I want to get Mark's take on it.
I hate, like sometimes I brag about being right all the time. This is one of those where I really hate that I've been right so far. Day one, and anybody that's attended the commodities report every week for the last 4 weeks can talk about, this has exactly been my stance. I've said it every time I popped on the halftime report on the lounge. My stance since the very first day that this broke out in China, where it was becoming news headlines, was, all right, I analyzed it. I came up with my own personal plan. I was like, I am not doing jack and crap until the worst of it is over, until it is apparent that the impact of this, there were too many unknowns.
Yeah.
I mean, the unknowns are still there and they're only amplified. But like since the very start of this, in the commodities report, I've been very clear. I've been like, my personal stance, I was like, and I always say that you can do whatever the heck you want, but until the worst of this is over, until you see a slowdown in cases, until you see that this has been at least loosely contained, I'm not doing anything. It goes to a philosophical approach I take towards trading and investing to begin with. In an unknown situation such as this, where you had these really big growth jumps at the very start in China, I was like, this is really rapidly spreading. I was like, I'm just going to sit out. And then as the weeks went on, as the market was hitting all-time highs, when I'd come on the halftime report of the commodities, I'd be like, well, I'm just going to be stubborn because I had an original plan. I'm not doing anything. The worst of it is over. And the worst of it was never over.
And yet I'm not sure the worst of it's over yet either.
Yeah, and so like, as the market was hitting all times, I was like, I'm just going to look stupid on this one. I'm just going to be stubborn on this one because I don't see, my original plan was until the worst of this is over, I'm not doing anything because it was lunacy to me what was occurring.
I go back to just not even just current situation. We've now had a zero growth environment for 18 straight months. 18 straight months in S&P 500 earnings. We're going to have another zero growth environment for the next year minimum. And that's if we actually corral this and it doesn't expand at levels that other viruses have. To me, it's not just a technical situation for me. To me, it's a technical situation. It's a fundamental situation. And obviously it's a geopolitical monetary situation. It's multifaceted. It's multi-pronged. I'm not going to overreact to any one day in the stock market. I'm not. I'm going to be data driven. And I think caution is going to be the word, not just for today. Caution is going to be the word for the next week, maybe the next month. But we got to be data driven here. We cannot be politically opinionated here. And my God, do not listen to politicians in an election cycle on this nonsense. Please.
You had me. You do not listen to politicians. Like you could have just stopped the sentence right there.
Especially in an election cycle.
There's two groups of people I want to shut the F up right now. Politicians trying to spin this for their own behavior, for their own thing on both sides of the aisle. No, this is not this. Come on, this is argue about Russian collusion to the end of the day. I don't think I brought up Russian collusion once on any show ever in tackle trading history because it didn't impact the stock market. This one obviously does. Stop. No, this is bigger than your own stupid vanity and your ego and all of that on both sides. And two, public companies. Like I saw Starbucks, trying to reassure, hey, we've opened up 85% of our stores in China now. What I want to know is anybody attending those.
Show me some pictures.
Like okay, we've opened them up. So I mean, this need to everything's good or things are. Is anyone? I want to know what consumer behavior is.
Well,
is anyone attending those?
It's going to take time. And guys, listen. Within a month, we might have that.
Yeah, absolutely.
We might have that. This doesn't have to take a long time, right? We need to be data driven. We got to leave the opinion at the door, and we just got to focus on our reading the technicals from a visual identification, understanding the data coming from an economic perspective. But for the love of God, don't listen to politicians because it's going to be it was going to be a nightmare this year anyways. And now we got massive volatility, perhaps a recession. Who's to blame? It's just going to be another nightmare. I'm going to hate this election cycle. Noah, what about you? You know, obviously we need to see the volatility subside. At what point do you start dipping that toe of yours into the water of the financial world and say, I'm not hedging, I'm not offsetting risk to cover calls, I'm looking to add to positions?
Well, let's address that elephant in the room. A lot of folks are feeling very shell shocked at the moment. They're definitely feeling, you know, if they've been stopped out or they've hit their max threshold and then, you know, had to ditch trades, or, you know, they've been caught in the emotional cycle of it and they're still holding and hoping. That's the psychological aspect of when you get back in. I think it's something you have to really consider, because the market, you know, however long the market takes to recover, psychologically, after I know in my trading, when I've taken a, you know, big old, you know, kick in the shins, we were, you know, had a big drawdown in the account, I'm always a little gun shy to get back in.
Mm-hmm.
And in this case, you know, I'm going to be cautious with the market. Going in all bullish, you know, I don't mind cost averaging in on some of the bigger blue chip type stocks that you really want to own, particularly if you have a good risk management skill set, like, you know, how to, you know, roll covered calls down, you know, how to buy your protective puts, right? You know how to call her.
Mm-hmm.
I'm less gun shy because I know how to do those things. But for the newbie who's out there, you know, it's okay to settle until you see the volatility calm back down and you see that VIX back down below 20.
I'm never going to let down bringing up the VIX, by the way. And by the way, nobody tell Tim. Nobody.
I already texted him.
Nobody tells Tim.
I won't tell him. I'll just say, hey, you should rewatch Thursday's halftime report. It was really good. And I'll let him find out for himself.
I'll know exactly.
If he doesn't watch it, though, then that's on him.
That's on him. Continue, Noah.
Oh, I mean, again, and as far as like what market signal it's going to be, I'm going to be patient with this one as far as waiting for good technical signals, because I think whatever rallies you get are more volatility ahead. Like I would look back to some of the trade war examples, like, you know, whipsaw up, down every other day, you know, hitting that moving average a few times. I wouldn't be surprised if we saw something similar where boom, maybe it rallies a day or two, then it's back down, retesting that zone. Maybe it goes lower. Because this, I think it's got the potential to cause a bigger, you know, not just, you know, the contagion of the virus, but, you know, like people getting margin calls and things of that nature, you know, forcing the hands, you know, of the banks to liquidate positions, et cetera, et cetera. So, you know, I've got some concerns on that.
I just pray, like the one thing I pray is, like, when you're talking about this real life pain, I really hope people listen to us during those weeks and weren't over leveraged. Because people that are over leveraged,
you can't do anything about that, Mark. If people are going to over leverage themselves, that is not something tackle trading has ever taught. That's not something tackle trading will ever teach. We teach proper position sizing, risk management, and risk of ruin. And so if somebody wants to portray their greed into the market and just hope they're going to make it get rich quick, that is not who we are. And that is not who our community is. That is not what we will ever be about, is get rich quick. We are about doing things the right way, position sizing properly, risk management, portfolio design, hedges, protection, you name it. So, you know, my hope is that people don't do that, but at the end of the day, people are going to do whatever people are going to do, and they're going to have to own that responsibility, whether they're right on their projections and they make a ton of money, or whether they're wrong on their projections and they lose a lot of money. But in this environment, in a normal environment, you should never position size over 2, 3, 4% in any leverage trade. And when you're looking at those leverage trades, you need to understand correlation between your swing trades. But in an environment like this, you should be shorting your time frames, and you should be tightening those stop losses. And if you're wrong, you take a very small hit, and you position size appropriately to the conditions of the time. I do have a couple questions, and I want to get to the questions. Stephen asked, do any of us buy long-term puts, not for protection? I get what Steve's going there. On the market. If so, what term? If not, why? So Stephen's basically saying, all right, if we expect a market cycle where we see a repeat of 08 or 2001, 2002, I think that's where Stephen's going. Instead of short-term trading, that downward movement where we're swing trading on bearish positions, buying put options on bearish positions, do you guys take like a 2-year look on this and say, I think this market could spin out of control and I want to take a 1 or 2% position size in out of the money put options on the S&P 500 or some leverage tradable instrument just to take like a little bit of a shot in the dark? I think what Steven's getting at, a very small position, long-term on something that makes money as the markets go down. Noah, let's start with you.
I'm going to start out with saying not with the VIX at 30.
No,
not with the VIX at 30. Now, if you were, if my hand was forced and I needed to do something with put options with volatility that high, I would have to do something in the world of a debit spread so that I have long and short volatility position, because because you're paying a big fat premium. This would be like trying to buy fire insurance while the wildfires, coming down the mountainside in your neighborhood.
Why you don't buy insurance on the market when the market's crashing, guys?
Right. So, if you'd picked that up before, yes, but I wait for the VIX to come down, wait for the market to rally, wait for the things to settle down, and then look at them. Yes.
But I think his question is going a little bit more deep than that, because Steven's been a part of our community for a long time. He knows he's not going to buy put options on the VIX at 30, right? Or not on the VIX, but he's not going to buy put options on the S&P at 30. But I think what he's talking about is taking that shot in the dark, long-term, just, wait till a nice little recovery. VIX comes down to 15. Then you buy a put option that expires, say, 2 years from now. That would be out of the money. Again, a shot in the dark that if we do see a 57% correction in the market that we saw in subprime, it would increase in value quite a bit. Could you sign up for something like that?
I'll jump in here because, yes, I do have a strategy where I do that. When the VIX is down at 12, I'll go out as far as I can, and I'll buy one at the money option. And then I automatically set a pre-sell for it at 20. So my one that I had purchased, I think I purchased it like 4 or 5 months ago on the VIX, back when it hit 12. It sold on Monday. Like, market opened and it sold. And I literally tell it that it's a triggered order. If the VIX is at 20, sell this at the market value. So yes, I do take that shot in the dark, but
Gino does some really good
what I realized with that strategy, though.
Well, and he's not even talking about the VIX. He's talking about the market, the S&P.
Oh, just puts on the market. No, I've done it on the VIX just as a shot in the dark.
Yeah, but that's kind of a short-term trade, because if volatility spikes, the VIX is going to go from 12 to 20 in 2 days, right? So Steven's talking about, I am looking at buying a put option on the S&P 500 when volatility subsides. Obviously, he knows volatility that would expire 2 to 3 years from now. That would be out of the money, 1%, 2%, 3% position size. That would be a slight hedge against a long-term portfolio. But what you're really trying to do is just make money on the market crash. Could you sign up for that?
Yeah, just again, wait for the market to rally and the VIX to settle before you do.
All I know is this, guys. George Soros has put options on the S&P that expire in 2 years from now.
Yeah,
I could absolutely sign up for it. I would just make sure that you realize the theta pain that you're going to feel from that thing every day that it goes by. You're going to witness it tick down in value. But you also have to know.
That's fine. I don't care. I know.
I'm just saying if you're going to do that.
I'll tell you why I don't care. Because taking a 1 to 2 to 3% position size when the VIX does subside and you're paying a good premium for that, not only will that protect your portfolio, it will give you peace of mind, and it will be cheap because you'll be out of the money. And if the market ever does spin out of control, you have the right to sell the S&P at a set price on or before that set date 2 to 3 years from now. I think it is an absolute wonderful, in this environment, hedging position as well as a speculative position, saying, okay, I'm willing to lose 3% of my portfolio, but I'm not willing to lose 57% of my portfolio. But I know he's not hedging from an insurance. I understand the logic here, because we are seeing very similar situations that we've seen in other times where the market did spin out of control.
But could you comment on, but like, that's not today when the VIX is at.
Again, I preface this for the 14th time. He knows.
I know, but I know people too, and they're like, I'm going to go like, it's like becoming, okay, whatever dumb thing you have done in the last month. All right. Because guess what? join the, I wrote an article a couple of weeks ago in the Commodities Report, Matt, about how we do dumb things. And none of us are immune to doing dumb things along the way. Like, we don't compound decisions like by, oh, I should have done this 2 weeks ago. I didn't, but now I'm going to do them today. And it's like, what is the advice to give someone today that has just did nothing to protect themselves on the way down here, that did nothing to adhere to stop losses, that did none of that today? Because they exist, and maybe they're watching this for the first time.
Take a deep breath. If this market recovers and your position recovers in any way, shape, or form, go ahead and be willing to pull it off if you get a rally. Because I don't see you're not going to get a V-shaped recovery in a market running back up to those highs. So if you got caught on anything, you get any sort of recovery or reprieve, and you're still sitting on that naked put and it runs back up. We'll close it back out when it runs up. But take a deep breath before, and don't feel, you don't want to trade out of anxiety and anxiousness. That's the hard part.
Make the right decision today. If you woke up and you have not been around the market for the last week and you're down 10, 12% in your 401k or your IRA, make the right decision today. Don't make that decision based on, oh my God, I've lost 10,000, 20,000, 30,000, 5,000, 2,000, 200. No, you don't make decisions based on P&L columns. Make the right decision today. So that's what I would say.
What do you think the real fear in the stock market is out there in normal everyday public?
A repeat of 08.
What?
A repeat of 08.
Well, I don't know. And this is what I found interesting. I talked to two people this morning. And I asked them, and these were not tackle trading members. These were real life people that I never, ever talked the stock market with. And I asked them, do you know what your 401k is doing this week? And both of them said, no.
Well, that's most people.
I know. What happened? But it's funny. It's like, how much, I mean, and once again, this is only speculation. How much of the public, literally has no idea what's going on this week with 401k?
80%.
Well, and how many people are still going to have their contributions go through on the regular paycheck, and they're going to buy on regular, schedule?
Most people are just living their life, trying to worry about their family and their community, and taking their kids to school and showing up at their job on time. And they get home and they're busy and they're tired, and they turn on Netflix and they eat their dinner, and they go to their kids' game. I mean, they're not aware. This has only been the social conscious for a week. These things take time, and that's why you don't rush out and buy and buy and buy. But I just come back to Stephen's question. I would understand it, a year, whatever it is. And I actually disagree with Marie. Marie, market cycles take a little bit longer than that. And the markets can stay down longer than you think, and they can go up longer than we can think as well. Buy in more time frame 2 years from now, even if you only expect to be in a trade a year from now, buying more time is always the right thing to do, 100%. A couple other questions. And Tom, my good friend from Hong Kong, I hope you guys are doing good over there, you and Wendy. So let me know. Send me an email, Tom. Make sure everything's okay. I met Tom about a year and a half ago there in Hong Kong when I was teaching. Another question we got in the chat here. I'm loving the questions here, guys. From Mohammed. Mohammed, great pro member. Mohammed, love you guys. Coach Mark, when is it a good time to buy gold? Let's take a look at gold real quick, guys. Gold, number one hedge. Everybody should own gold. It's a hedge. What's your read on gold? When's the time to re-add here, Mark? What do you think?
We hone in on the daily price chart.
Oh, sorry, 1 hour chart. I was getting all excited there for a minute. For some reason, I got 20 years loaded up. Man. All right, there you go.
Okay, so for those people, because we are having a lot of people tune in for the first time on the halftime report. So our position on gold for 14 months as a team has been extremely, extremely bullish. We've differed on the advocacy of, while it's at these cycle highs, about the pinpoint. I've been more lob puts down this whole market up. My approach has been a more cautious. All those puts expire worthless. Your ROI is a little lower, but I would like to acquire it hopefully at lower levels. So selling those puts, down several strike prices, that if you have a short-term pullback, you can acquire gold. Everybody's on board, right? Still with gold ownership, the fundamentals, all of that. I mean,
it doesn't matter if gold breaks 1600. I'm on it.
Like, so, I mean, we have been very, very pro gold for 14 months. We're not gold bugs. We're not like, but for 14 months, the fundamentals of gold have been really, really, really strong. None of those fundamentals have changed. Like whatever the specific coronavirus fears are and what they do, the likely outcome here is monetary stimulus by the Fed. Well, I should say additional monetary stimulus in the form of rate cuts, quantitative easing, whatever it is. That's almost a given if the coronavirus gets any worse. It's just a given. The when of it, who knows, but it's a given.
Hell, it might be a given if the coronavirus is cured tomorrow.
I know. So, right, exactly. And so like the fundamentals behind gold remain as strong as ever. It has been a good run. Those fundamentals are not changing anytime soon. So the only question then, so everyone's on agreement, right? Here, Noah,
yeah.
Matt, Cody.
Yeah.
So wait, what did I just agree to?
The underlying fundamentals of why
the underlying fundamentals of gold are strong.
Oh yeah, I agree. I would have agreed anyway because just Mark was so convincing. But yeah.
All right. So
you should have said like you just agreed to buy me some gold or something, and then be like, all right, no, just send it to my mailbox.
All right, send me your address.
So we have this general premise: fundamentals are good. Now the only question remains price. Are you comfortable at what level getting into gold? Fundamentals are strong, don't appear to be changing anytime soon. So
doesn't
now
it depend though, Mark? I mean, if your position to swing trading price is important.
I'm only talking investing, hedging as against a portfolio, long-term cash flow gold. That is the only thing
if I'm looking to buy gold as a hedge, I don't care about the price.
So Matt's like, hey, if I want to add gold, I'm just going to add gold, but that's one of the power of education is that we also know that we can make a little bit of money through the selling of puts at lower levels, that if you were to have gold put back, one of two things happens. Either one, you get put the gold and you acquire gold at a cheaper level, or two, you get the premium from the selling of the put. And that is generally the approach I have taken for going back 7-8 months now. Now, you give up a little bit of price appreciation if gold were to skyrocket, but that's the approach. Both approaches,
they're fine.
You made money with both approaches in the last 14 months.
It's just a matter of how you want to approach it. If you want to cash flow to pay a cheaper price, I mean, there's nothing wrong with selling a put option on GLD and taking a little bit of cash flow at a support level you're comfortable with taking possession at it. And if you're looking to add it as a hedge, there's nothing wrong. Nothing wrong with adding it wherever the price is.
And over the last 8-9 months of this, my approach would have produced lower ROI than simply purchasing it. But so like you're still making money, the actual purchasing it. And if gold were to go to 1800, my approach is going to make you less ROI than just acquiring it today. So, but that's really the question for me is fundamentals are great. I mean, once again, I stick to what I have always done. With commodities, this is how I approach it. Sometimes it produces good results. Sometimes it produces stellar. But I'm always going to be lobbing those puts at cycle highs on when I think the fundamentals are strong.
Next question, guys, and I'm absolutely loving the questions coming from the community. Great job. Mark says, can't you hedge your condors with buying a put on IWM? I had a call from one of my students just recently, actually yesterday, had some bull puts on a couple companies. And obviously with what's happening in the last couple of days, the market volatility is really kind of putting a lot of pressure on those strike prices that we like selling on bull puts, bear calls, and so on and so forth. And, my answer, Mark, to him was, well, there's a conservative way, there's an aggressive way, and then there's just the I want to get out way. The aggressive way to hedge a condor or a bull put or bear call is if the volatility is moving to the downside, you can go out there and you can buy a put option on IWM to hedge against that bull put spread. Now, the reason you're hedging is because the volatility is moving to the downside, which means you're turning it more into a debit spread, which is more aggressive, which means you need the market to continue to go down. But it is a good way to hedge it if you want to be aggressive in that capacity. The conservative approach would be to sell a bear call spread, sell an additional bear call spread against it, Mark. So Obviously, as the market is coming down, the value of those put options are increasing, but the value of those call options are decreasing, which means you would buy back the bear call spread at a very cheap buyback price. Whether you, let's say you received $100, man, those bear call spreads are now worth what, 10 cents, 5 cents? You buy back at a very cheap price, you know, and then reissue to bring in another credit against that bull put spread that's showing the loss. That would be a little bit more of a conservative approach. And then the get out is just say, okay, I just want to get out and just, you know, lock in my profit on the bear call, take my loss on the bull put, wait for the volatility to subside, and then start to reissue those condors out there. That's a great question. Paul says, hey, coach, would a bull put spread be a good alternative option on GLD? I'm not sure, Paul, you have the premium to really do that bull put, but the reason we want to do a naked put or just buy the gold is for that hedge. The bull put spread is not the hedge against the market volatility. You're just looking to cash flow on that. Now, if you're just looking to cash flow on that, Paul, yeah, I could absolutely see a reason somebody would do a bull put spread on, say, slash GC in the futures market, maybe GLD if you can get the premium there as well, because gold is going to kind of, as we've seen over the course of the last couple of days, when the market volatility is coming down, it's kind of held that ball, it's kind of held its channel at the top end. So I could certainly see somebody saying, I'm going to sell a bull put spread on GDL or slash GC, because just you simply think gold is going to either maintain its current levels or appreciate, and you simply want to cash flow. But if you're looking to add gold as a hedge, add GLD or add or like Coach Mark was talking about, a naked put there. Guys, I think that was a wrap. Great show. Hopefully you guys enjoyed the show here today. We wanted to really thoroughly kind of break down the markets, both from a technical perspective as well. I've had these discussions on it. Really enjoyed the questions here today. And for you guys who have not watched the Tackle 25 Mastermind group from last night, guys, this is the environment where management of covered calls are so very important. And I thought Coach Noah did an absolute great job of teaching the management of the covered call yesterday. So definitely make sure you're watching that mastermind group. I'm sure it's posted to the website already. And if you are not a member of Tackle Trading, make sure you go out there to tackletrading.com, sign up for a 15-day free trial. You can also get that 15-day free trial. I believe there is a link in the description of the halftime report, and come see what all the other pro members of Tackle Trading really enjoy. Guys, at the end of the day, we're a community of like-minded investors all coming together to navigate this volatile world right now together. And we're going to be here every day with you guys, bringing you the truth of the market, whether everybody loves it or not. We're going to certainly give our opinions. Coach Mark, great job. Coach Noah, great job. Coach Cody, fantastic hosting today. And with that said, guys, we will be with you late tomorrow. We do have the Cash Flow Club tonight, guys. So make sure you're in the Cash Flow Club tonight at 8:30 p.m. Eastern for those pro members as well. Got the scatter reports coming out this weekend. Man, we're going to have a tough job this week, guys. It's going to be a tough job, but we're going to do that job, and we're going to scan every stock in the market to bring you the best potential trades coming out in the market on a weekly basis. With that said, guys, we're out.